Let's take a look at how risk or volatility is measured and what it actually means to your portfolio. Now, risk is what we refer to as movement. Now, movement in a portfolio of stocks or bonds or any equities is going to go up and down, but we're not hyper concerned about how much. It's just about the movement. Now, when we refer to standard deviation, it sounds very financial industry geek speak, but it's not. It's about what our expectation is when we invest in the given market. Now, let's take an example. The S&P 500. It's a well-known index of 500 of the large U.S. company stocks. Now, we know the average in that index is about 10%. But 10% is an average. It doesn't mean that it's going 10% every year. Rather than 10, 10, 10, 10, 10, you're going to have a lot of movement for any given year with that index. And that movement is the standard deviation. So, to clarify, 10% being the average of the S&P 500, the standard deviation is the degree of movement away from that average. Our expectation is therefore 10 deviation away from that. So in any given year, you could be plus 10 or plus 20, and that's fine. Some years you might be minus 32. Well, that's a deviation from our expectations. So the question is there something wrong? Is there something broken? You shouldn't ever be plus 60 or minus 92 in our case, the S&P 500. What we are really talking about here is a concept of risk from a historical perspective. So when we make allocation decisions, we're ensuring that we're making them to increase the likelihood that you have the potential to be compensated for the given amount of risk that you're willing to take. For more information, click on the button below, like and subscribe.